Welcome to our CFP exam prep discussion on charitable contributions and their tax implications. Today, we're diving deep into one of the most frequently tested areas that many candidates find challenging. Let's break down charitable contribution deductions based on adjusted gross income and property types. For cash donations to public charities, the deduction limit is 60% of AGI. This is the most straightforward type, but here's where candidates often make mistakes. They forget that this 60% limit only applies to cash gifts to public charities, not private foundations. For appreciated long-term capital gain property donated to public charities, the deduction limit is 30% of AGI. This includes stocks held for more than 1 year or real estate. A common exam trap is confusing the fair market value deduction rule. You can deduct the full fair market value of appreciated long-term capital gain property, but don't forget the 30% AGI limitation. When it comes to ordinary income property or short-term capital gain property, the deduction is limited to cost basis, and the AGI limit is 50%. This is where many test takers slip up. They incorrectly apply the fair market value rule to all property types. Remember, for inventory or property held less than 1 year, you're limited to the lesser of fair market value or cost basis. Let's look at a practical example. Say your client has an AGI of $100,000 and donates $70,000 in cash to their local church. They can only deduct $60,000 in the current year because of the 60% AGI limitation. The remaining $10,000 isn't lost. It can be carried forward for up to 5 years. This carryover provision is crucial and often appears in exam questions. Here's another scenario that frequently shows up on the exam. Your client donates stock worth $40,000 that they purchased 2 years ago for $15,000 to a public charity. Since it's long-term appreciated property, they can deduct the full $40,000 fair market value, subject to the 30% AGI limit. With an AGI of $100,000, they can deduct up to $30,000 this year, with the remaining $10,000 carried forward. A critical concept that often trips up candidates is the ordering rules for carryovers. Current year contributions are always deducted first before any carryover amounts. When you have multiple types of contributions and carryovers, it gets complex, and this is where the exam likes to test your understanding. Some other common mistakes to watch out for include failing to recognize that contributions to private foundations have lower AGI limits. Cash donations to private foundations are limited to 30% of AGI, and appreciated property is limited to 20%. Also, don't forget that the fair market value deduction for appreciated property only applies if it would have generated long-term capital gain if sold. The key takeaway for the exam is to first identify the type of property being donated and the type of organization receiving it, then apply the appropriate AGI limitation. Finally, remember that excess contributions can be carried forward for 5 years, but current year contributions must be used first. Understanding these rules cold will help you navigate through some of the trickiest questions on the CFP exam. Remember to always read the question carefully and pay attention to the type of property and receiving organization. These details will guide you to the correct AGI limitation and deduction amount.